Well, joining us now is Homayoun Falakshahi, Senior Commodity Analyst at Kpler, to discuss some of these issues in more detail. Homayoun, thanks for joining us. Let's start with that decision by OPEC Plus to cut production. What's motivating it?
Hi, and thanks for having me. I think, OPEC Plus had to do something. They pretty much had no choice but to take one big step, and this is a relatively big one. The first thing we can say is that they're trying to protect the band of $90 per barrel Brent, more or less. That's the first thing. Second thing is they're probably trying to build a bigger cushion between now and the beginning of next year, when European sanctions on Russia will become effective, and we still exactly don't know how much Russian oil we're going to lose between now and then. So taking that decision gives them a bigger buffer between now and then in order to fight volatility. Obviously, the mood is bearish across the market. So here, OPEC Plus was trying to put a floor and defend that band of $90 per barrel for the oil market. Sorry.
I mean, the US has called the cut short-sighted. Other analysts are saying it will benefit Russia. Are those views right?
To a sense, yes, it is, of course, because it keeps prices relatively higher. And as you know, Russia has to offer relatively large discounts in order to sell its oil. And this is likely going to be even more the case from December onwards, when European sanctions will come online. So the higher prices are, the more beneficial this is to Russia. But I mean, OPEC Plus and Russian cooperation has now lasted for about 6 years. It has worked over the past 3 years, and relationship between Russia, especially Saudi Arabia and the UAE, has grown stronger, even beyond energy. So this is a reflection of that as well.
Some have accused OPEC of undermining global energy security and exacerbating risk of a global recession. Do you agree with that view?
I think to a sense, yes, of course, because we are starting to see demand destruction, or not so much demand destruction, but that growth that we were having post-pandemic has really slowed down. It has killed that growth, but that is mostly related, we think, to the strength of the US dollar. If you look at the price of Brent in euros, it's at the highest ever. That's not the case for when you look at it in terms of dollars, because Brent has fallen more than $30 compared to early June. So the strength of the US dollar is having more impact, we think, than the latest OPEC Plus decision. But of course, this is also helping. This is also pushing, supporting that.
We've seen a drift in prices today. What's pulling those prices down, and what's the outlook going forward?
I think obviously, we were hearing those rumors around a cut being made last week. So a lot of the price movement was already priced in Monday and Tuesday, when you had that big spike in oil prices. And also the 2 million barrel per day cut is not a 2 million barrel per day cut in physical markets. So the real cuts, we think, are not going to really disturb supply dynamics. The actual cut, we think, are going to be even below 1 million barrels per day. So it looks to us that the price of oil in the short to medium term is going to be range bound between probably $85 and $100 per barrel, until the next volatility catalyst comes, and that's the EU sanctions on Russia starting in December.
Homayoun Falakshahi, Senior Commodity Analyst at Kpler.